You can't control what the future holds, but you can take control of your investments with principle. Whether your goal is to enjoy a comfortable retirement or to secure your financial legacy for future generations. After all, your future and aspirations are worth investing in. That's why we offer a wide range of fund options that gives you global and local exposure for better returns. With more than 142 years of global investment experience at your fingertips, you can take full advantage of opportunities to build your wealth. And we make it easier for you to manage your investments with our enhanced digital solutions. Now you can easily buy, redeem and switch your investments at your own convenience with our easy-to-use online investment portal. Never miss the right opportunities to invest with cash or iInvest. As you build your legacy and aspirations, we will be by your side to help you secure the future for you and your loved ones. Start taking control of your investments with principle today.
Good evening, ladies and gentlemen. Welcome to Principal's webinar, The Great Wall of Investment, Opportunities in China. My name is Farah and I am your moderator for today. Before we get started, let me go through some housekeeping. The webinar will take about 30 to 40 minutes with Q&A. If you wish to ask the presenter a question, please submit your question throughout the presentation via the Q&A chat box, which is on the right side of the screen. Type your question in the compose box and select send. Please also indicate your name if you like, or you can choose to submit anonymously. And due to time limitation, we will answer those questions with the most likes at the end during the Q&A session. I would now like to welcome our presenter for today, Patrick Chang, CIO of Equities, ASEAN and Malaysia. A little bit of background on Patrick. Patrick joined Principal on 22nd February 2016, and he comes with more than 20 years of experience in asset management industry. Patrick was previously the head of ASEAN Equities at BNP Paribas, investment partner Malaysia, where he oversees ASEAN Equities for both Malaysia and offshore clients from 2011. Without further ado, let's have Patrick over to you. Patrick?
Hi, thanks, Farah. Good evening, everyone, and welcome to this webinar on China. Before I begin, I just want to take this opportunity to thank the team, especially the digital team, for organizing this. I think this is a very apt moment for us to discuss about China in light of what's really happening globally. And secondly, where I think where I'm very passionate about in terms of what we call the wall of investments and opportunities that we see in China. As you know, I've been a very big bull on China for the longest time, but of late, obviously, there has been some volatility in China. We'll discuss a little bit about that later on. But without further ado, I just wanted to touch on a couple of key points on what I call China 101s, which I think is very important to put into perspective the history of what I think China has been and will be in the future, and what we think going forward are some of the themes that you need to think about when you invest in China. So when you think about China, I wish I could actually have a poll down here. You know, one of the first things that you think about actually is leadership, right? So, you know, the astonishing thing about China over the last 5 decades is from the times of Mao Zedong all the way up to where we are today, led by Premier Xi Jinping, right? Essentially, you can see here in the chart that the growth or the trajectory of GDP, which is the number that people look at in terms of growth, has grown tremendously, right? And it is astonishing because of the transformation of the Communist Party to where it is, to where I think it's a socio-economic policies, where if you think about it over the last 3 decades itself, on the next slide, you can see essentially that China has grown from a very small economy to basically a very rich economy, one of the second largest economies after the US. To give you some facts, Essentially, if you look at the next slide, China has grown from a very poor country in 1980, where the average GDP per capita, 90% of the population was only making about $2. To date, they're making an average GDP per capita about close to more than $10,000. More than about 500 million people over the last 3 decades have actually come out of poverty. And I think this is a very, very important point because it drives consumption. And you know, and I know that when you go to Europe, or when you go to China, for example, or you go to Hong Kong, for example, whether you're in Louis Vuitton, Chanel, or any other shops out there, you have to queue a long queue simply because the purchasing power of China consumer base has grown tremendously. And I do think that at the end of the day, this is something which is a phenomenal state which no country in the world has ever achieved over the last 3 decades. And the other point I want to talk about in terms of, more importantly, closer to my area is in terms of investments, is that, not a lot of people know this, right? But next slide, please, is that the Chinese stock market itself, people always think about the New York Stock Exchange and NASDAQ and so forth, right? But if you were to combine basically the Shanghai Com and the Shenzhen Stock Exchange, which is a home for, obviously, as you know, a lot of technology companies, it's basically like a Silicon Valley of China. And you combine, for example, the Hong Kong Stock Exchange, you're close to about two, very, very large exchanges, right, of the world, right? But ironically itself, it only represents about 3.3% of the world index, which tells me at the end of the day, this large economy is underrepresented in the global scale. The second point is that people are basically not really appreciative of the kind of growth trajectories that we're talking about. And I do believe over the medium to longer term, once you get past all these zero COVID issues, once we get past the transition of the power, once we get past all the US trade tensions, for example, I do believe that the recognition of China as a financial center and as well as a stock exchange of the world will gain even more recognition. And I think the flows in terms of money flows will start to come back into China. So that is basically how I see China. And just for fun as well, this is my favorite chart on the next slide. A lot of people know that Chinese consumers are the biggest purchasing power, right? But interesting enough, the real driver of the fact that people are buying a lot of Louis Vuitton bags and Chanel bags and whatever bags out there, or shoes, is simply because that the average Chinese consumer have been, on average, being the net saver of the world, right? Compared to the US and compared to advanced economies. You can see this chart now here. So savings rate in China is very, very high. And that is one of the reasons why they go out there and buy new homes. They go out there and buy very high, and which we'll talk about a little bit later in terms of the purchasing power and the democratic dividends that we have in China itself. So that's basically what I think about China. When I think about it, I think about the transition of the political power. I think about the stock market itself, and I think about the power of the consumer, which accounts for about 50% of GDP today. Now, where do we go from here, given all the very, very solid fundamentals that we see in China? The way I think about it, let's just recap of where the stock market is telling us today. So on the next slide, I'm going to give you a big summary of why we need to invest in China today. First and foremost, let's recap the markets. This is a very busy chart. It tells you a lot of information, but what I want you to just highlight on the middle column down here. When you talk about China, you talk about two major markets. You talk about the onshore market, which is the A-share market, which is the likes of the Shanghai Com and the A-share market. And you also talk about the Hong Kong listed Chinese stocks, which is the H-share market. Interestingly enough, if you look at it since 2018, where it came down by 25%, it rebounded by 22% in 19, and it rebounded by 14% in 2020. And despite all the political issues that they had and all the re-regulation changes in terms of technology and all that, the Shanghai Com was still in the positive territory. And year to date itself, as of July, the Shanghai Com is down by 10%. The H-share market, on the other hand, which is owned by a lot more foreigners like myself, is down 3 years in a row. And I'll talk a bit about later how depressed it is. And I think this is where the opportunity is. But then again, putting in perspective as well, other developed markets, whether it's MSCI World, S&P 500, the European markets are also down this year. So basically in that Chinese market, foreign market, H-share market has been down, but I think this is where it gets a little bit more interesting. Why does it get more interesting? Next slide. Because I do believe that valuations are getting extremely compelling. The Chinese price to earnings ratio, both on the A-share market and the H-share market, are one of the lowest I've seen in a long while. You can see down there on the left-hand chart, basically the H-share market itself, which is the red line itself, is trading about 8 times PE, and then the A-share market on the blue line on the left-hand column is growing about mid-teens. Why is there a discrepancy? Because ironically, the onshore guys believe that this is an opportunity, and then I will talk about a bit later why they do believe in that. But I do think that a lot of foreigners are looking only at the bad news, which is basically regulation changes, political risks, trade issues, and so forth, right? And obviously, basically, we can discuss all those issues a little bit later. But I do think that from a relative basis, from a risk-reward basis, if you were to think about the market today and what it is pricing in today, the risk reward for the Chinese market, both on the A and the H, particularly from the H market itself, is giving us a lot of opportunities to invest. So I think, next slide. Now, this is a very interesting chart, which we have been observing for a while. And this is basically a recollection of history. So we basically analyze how much of this correction is overdone and the duration of the correction. And history has shown that the average bear market in the Chinese market lasts between 9 to 12 months. This current bear market that we're seeing in the H-share market has lasted close to about 18 months. To me, it has gone very, very long in terms of being bearishness. And history has shown usually when the market falls this severely, and if you've seen that in the 15 and 16 correction, the next 2 or 3 years, markets do generally rebound. Will history repeat itself? Time will tell. But I do believe at the end of the day, when valuations is cheap, the fundamentals continue to be slightly more compelling than before. I do believe that things are being priced in. I think the bad news, is being priced in. So I think at some point, this is going to be quite overdone. Now, having said that, we are not saying that the volatility is going to go away. I don't think so as well, because there's a lot of macro issues that are still ongoing, the property issues, which I'll talk about a little bit later, the ongoing tensions between the US and so forth. So I think these are all going to be kind of noises that's going to happen in the background, right? But if you take a longer term view in the next 6 to 12 months, especially after the party congress in November, I think there's going to be a lot of more things happening after that. To date, as we speak, right, Xi Jinping has come up from his summer camp, 2 weeks with all of his senior political chiefs, right? And I think he has been very, very busy already telling his team that we have to go out there and pump prime the economy and support the property market and so forth. So I think they are ready to make sure that stability continues. And I think this market is ripe for a correction, for a rebound. Next. The other point I wanted to talk about is that when we talk about the A share market, what is also quite interesting when we observe is that the Shanghai Comp is actually more resilient than the H share market. Now, why is this the case? You can see the chart on the right-hand side down here, right, where you can see basically the equity positions by the local investors, which means onshore investors in China itself. In the month of June, when it was the most bearish itself, the private positions of a lot of these mutual funds has increased by about more than 10%. And that subsequently led to the rebound in the Shanghai Comp, right, from about more than 10%. I think this is a trend that's going to continue because there's lots of liquidity in the marketplace. And having said that, if you've seen in the chart before, the savings rate of the average consumer in China is very, very high. Hence, the reason why they have to put money to it, or rather to invest. And I think the stock market being where it is today is giving them a chance to a more compelling opportunity to invest. So I think if you follow the locals in terms of where they are invested in, I think it's very, very interesting. I just had a call yesterday with our partner, CCB Principals. Principal basically owns about 25% in the third largest asset management company in China. And their view is that I think this is not just a 1 month blip. I do believe that they think that they're going to say that basically the net increase in conversions of cash into the equity market will continue. And I think going into the Party Congress in late October and early November, I think the market will be well supported. So think about it this way, right? I think there is two differentiated markets out there where the foreign investors who are invested in the H-share market are obviously very bearish. But when you think about where the A-share market becomes the leading indicator of the economy onshore itself, I think it's going to be very interesting to see what happens in the next couple of months. Next. And then, of course, when you think about China itself, especially in the A-share market itself, right? What is quite really, I mean, this is very technical, right? But what is quite interesting is the resilience or the non-correlation to a lot of developed markets. So in other words, as you all know, right, when you wake up in the morning like myself and you switch on your Bloomberg and you think, oh God, Dow is down by a couple of 100 points, what have you, right? Does the Shanghai Com react to that? Not really. You can see down here in the chart, the correlation of the MSCI China A share to the North American MSCI is only by 0.3%. Likewise, for example, if you were to compare that against Asia and Japan, it's only by 0.4. Meaning to say that to a certain extent, the onshore market, the A-share market itself, is starting to decouple from the global equity markets. This is a very interesting phenomenon, which means that when I told you about just now, the second largest stock market in the world today is behaving like it is a global market itself on its own. It tells me that it is beating on its own beat. It is moving in tandem of its own fundamentals, despite all the noises that you hear from the foreigners who are very, very bearish on the H-share market. So that's a very, very key point. And that's what gets me excited about investing in China today. Next. Macro. I want to spend a bit more time talking about China macro because there's been a lot of noise about China macro, how bad the GDP is and all that. The truth of the matter is, if you look at the right-hand side, right, the China manufacturing and the non-manufacturing PMIs have rebounded. No doubt the blue line, which is basically the manufacturing index, is somewhat subdued. But then again, it is subdued because, we are now in the summer months. It's very hot, as you know. They're going through droughts, so therefore PMI numbers are good. But you look at the services sector itself, is still above the 50 mark, which basically portends expansion. But more interesting enough, right? We monitor this on a monthly basis on a left-hand side. We started to monitor, for example, traffic rebound, right? And this is traffic. This is car traffic, right, in the city itself. People talk about zero COVID policy, how it impacts the retail consumption. Like, yes, it does impact consumption, but people are also going back to normality. And this basically, the traffic rebound that we're seeing after the lockdown, you can see here, whether it's Beijing, Guangzhou, Shanghai, and the rest of the China big 15 cities, essentially, they've come from the bottom in the May or June, and then they're starting to rebound. What it really tells me at the end of the day, from what I hear from my colleagues in Shanghai and Beijing, is that despite the fact that number of cases are rising, people are starting to go back to normality. And I think this is a very interesting sign of hopefully some form of rebound in terms of consumption and retail sales going forward. Next. Inflation. Now, we all know inflation everywhere in the world, including Malaysia, including the US, as well as in the UK, as well as in Europe itself, has been very, very high. You can see here in the chart now here, whether it's the black line on the US, where inflation numbers are about close to 7-8%, Eurozone is about close to 4-5%. But China itself, even despite that it blipped up a little bit, you can see down there on the purple line itself, right, it's barely above barely above the 3% mark, right? Indications that inflation numbers, because of the COVID lockdown itself, going forward, is going to be more subdued. Why does this matter? It matters from a monetary policy point of view, because it means that this is the only country that we can think of globally that is able to cut rates in an environment where growth is going to be subdued. Meaning to say, this is the only country that I think of where monetary policy, which means the ability to print money, is going to be even more accommodative than any other country in the world, which tells me that if there is going to be a slowdown, which is happening now, they are able to then use both monetary policy and fiscal policy, which means they spend money on infrastructure spending and build, more infrastructure for roads and so forth to prime the economy. And I do believe that that is a very, very powerful tool in the economy, which is, I think, which has been plagued by the zero COVID policy. Next. Macro policy, you've heard the story the last couple of days. They have been continuing to cut rates by 10 basis points. I think this is still fairly early days of cutting rates. I think they can still do more, but I do think that at the end of the day, most of these low rates are to support basically government financing and also to prop up the property market, which I'll talk about a little bit later in terms of the issues that we have in the property market recently. Next. And then, of course, this is a very, very interesting chart, and that tells you basically that the government is having a lot of ammunition to issue lots of bonds. When you issue lots of bonds, you inject liquidity into the market, and when you inject more liquidity into the market, you are basically then able to underwrite a lot of infrastructure spending. And so I do believe in the second half of this year, local government bond issuance, you can see down there in the blue line, will continue. At the moment, they have already issued about close to 1.5 trillion yuan, which I think is still early days. I think there's still more. Back in 2009 itself, in the height of the global financial crisis, I think they did about close to about 500 billion US dollars. But then again, the GDP at that time was much smaller. So I think they can still do more. As you know, they have been deleveraging, which means they have been reducing the number of debt in their bond issuance over the last 2-3 years. So hence the reason why I think they are now in the midst of basically issuing more liquidity in the system to pump prime the economy. As of the last 24 hours itself, I think Xi Jinping and the government officials of PBOC are already talking about pump priming the economy. So I think that will set a lot more. It will underwrite basically in terms of a lot more infrastructure spending in the second half of 2022. Next. And this is a very, very busy chart on a long list of fiscal policies, which I wouldn't go too much. But I think the key message here is that the Chinese government itself is tweaking the economy in an environment that is very, very difficult today, right? The problem that we have today in China today is that, unfortunately itself, right, Xi Jinping and the government itself is very, very adamant of the zero COVID policy. The zero COVID policy itself has basically cornered themselves into a lot of issues, which basically leads to the slowdown in the economy. But having said all that, despite the fact that they are in a zero COVID policy, I do believe that they are tweaking the economy. And as you know, as I said before, the Chinese economy at about close to about 16.5 trillion US dollars today, growing at about 4 to 5%, which accounts for about 825 billion on a year-on-year basis, close to about 2.2 times the total GDP of Malaysia, by the way, right, is huge. So the base of the GDP, the nominal GDP today in China itself is very, very big already. So even despite the fact that people say you're slowing down, what does it really mean by slowing down? 4-5% of a 16.5 trillion is huge, you know, right? So even if you slow down by 4 to 5%, it's not that bad. The US government is only growing about 2%. Europe is barely growing. Japan is barely growing, right? So I think they are taking the opportunity that the fact that we are potentially going into a slowdown in the global economy, particularly in the first quarter of next year, then, you know, you can slow down a little bit, readdress all the issues that we have, like particularly in the property market, and basically, you know, kind of inject some liquidity as you go along to make sure that you stimulate the economy. So I think what I'm trying to say here is that the China macro story is all about stability. And it wouldn't surprise me in the next 2 quarters itself that the headline GDP numbers that a lot of economists are anticipating will be weaker than anticipated. But yes, guess what? A lot of investors like myself have already priced that in because the market has gone down that much already. Second point is, I think even if it goes down further, as I said early on, they have the ammunition to stimulate the economy through fiscal means and monetary means even more than before. Thanks. Next slide. China property. I had to have this slide because that's top of mind of a lot of investors today. You can see down here, China property sales have collapsed over the last 1 year, and that's an event of Evergrande. Now, the key point I want to try to make here is that this is not a financial crisis similar to what we've seen in 2008 in the US. This is not subprime. This will not be a systematic crisis. And I was speaking, I spent the last 3 or 4 days speaking to a lot of economists in China and getting a sense onshore of what kind of policy response that the government will do, right? And the conclusion from the local industry itself is that you've already started to see an injection of liquidity, particularly from non-SOE related property companies as a first stage, and to shore up the liquidity. The real issue here today is not that a lot of these guys in the property sector have no funding. The real issue is that basically they have a balance sheet issue. So when you have a balance sheet issue, you need to basically tweak the balance sheet. So you saw that in Evergrande, you saw that in a lot of other smaller companies as well. I think the non-performing loans of these companies will be able to be supported by the government. Of course, a lot of investors out there are not investing into the property because they're walking away from the mortgages and all that. I don't, these kind of loans are only accounting about 1% of total loans, right? So to put things in perspective, even if all of these loans go to bad, I don't think it's going to hurt the banking system in China. What really matters today is to show up the confidence of the end consumer out there who are buying the property. So interesting enough, so I started asking questions about what about the secondary market? So people do not want to buy uncompleted property. They want to buy a completed property. So what's really happening now is that people are waiting for fire sales, but the fire sale is not happening because the government controls the prices of property in China. So what really happened now is that they're going out there and buying and waiting for secondary market prices to drop, and they'll buy because they have a lot of cash. So I think we are not in the kind of environment that will be systematic, which means that it will be a financial crisis. I do believe that the government itself, property market accounts for about 40% of the GDP, right? So the last thing I think Xi Jinping or the rest of the PBOC or the government in China will do is to let the property market collapse. But I doubt that's going to happen, right? If that happens, then I'm going to be out of job because I'll be lying to you about how to invest in China, right? So I think jokes aside, right? I think this is something which is serious. I'm not making any jokes about it, but I do believe that the Chinese government has some control over it. And I think once we go past the next 2 quarters itself, we'll see more clarity in terms of the property sales, and we see more clarity in terms of the balance sheet repair that's going to happen in a lot of these property companies. So that's basically, in a nutshell, my views on China. The other one is, next slide, structural trends, right? I really wanted to touch a little bit about long-term structural trends in China, just to give you some perspective of how I think about China over the next 5 to 10 years, right? You hear a lot of things about the dual circulation. I think that's ongoing, which means that the government itself wants to make sure that the bigger pie, moving away from manufacturing to consumption, will continue. The most important thing that you need to take away from this 4-pillar slide is key point number 2 and key point number 4. And that is the fact that I think the government itself or Chinese Inc. itself wants to be even more sufficient in terms of technology. And second point is that with climate change being on the forefront of a lot of global economies itself, I do believe that the emphasis on infrastructure spending as well towards renewable sectors is going to be even more pronounced. As we speak, in most of our portfolios, whether it's Chinese portfolios or the Asia Pac portfolios itself, we are increasingly buying into most of these sectors itself because we think these are structural, and it moves away from any kind of policy changes that may have just in case anything happens from a policy front, right? So I do believe that this is something that are long-term in nature, but I think more in terms of the long-term trends as well. On the next slide. When you think about the average Chinese consumer, right? I mean, we joke about the Pradas and the Chanels and all that, but when you think about the Chinese consumption pattern over the last, especially over the last 5 years, it has changed tremendously, right? I haven't been there for the last 3 years, unfortunately, right? But last time I was there, you can see even in some of the low-tier cities itself, right? People are more self-conscious about health. And more discerning about how they spend, and also they are more discerning about how they travel as well, right? And you know that, for example, one of the best favorite destinations by a lot of Chinese consumers is to Korea or even to Thailand, for example, right? Of late, you can see that the number of the traffic in most of these airports itself, right? I was just in Bangkok last week, right? And I hardly saw any Chinese consumers out there, right? So it's been a very quiet airport, so to speak, But I do believe that once they come back again and they're going to spend even more, I do believe that the Chinese consumers are going to drive a lot of consumption in Southeast Asia. But I think at the end of the day, right, the next point I want to say is that, next slide, is on the renewable side, right? I think this is something which it gets me very excited, because if you look at this chart down here, right, over the last 2 to 3 years, particularly up to FY19, right, the number of green bonds and supporting decarbonization itself has been a rise. I think Chinese green bond market is probably the second largest, or if not the largest in the world, right? And so I think they are now shifting their energy consumption to promote clean energy. And I also believe that as some of you have been to the major cities in Beijing or Shanghai or Shenzhen, right? Most of you open your windows in the morning and you can see a lot of pollution and all that kind of stuff. The fact that a lot of the manufacturing sectors are about a couple of 100 kilometers away and is impacting the cities is really not really healthy for the average people in China, right? So I think China has woken up to the fact that carbon neutrality is going to be a norm in the future. They have committed to the the carbon neutrality by 2030, and I do believe that development of large-scale wind as well as solar projects are ongoing as we speak. Right, on the A-share market itself, a lot of companies, especially in the small cap space as well as the mid cap space, something which have been brewing over the horizon, which doesn't get a lot of attention by a lot of foreign investors. But we have been starting to invest in some of these companies, and very, very exciting opportunities out there, right? So if you think about the long term in terms of renewable energy and decarbonization, some of our funds have exposure towards this. Last but not least, this is basically next slide, please. It's a long list of a wish list on the things that we want to invest in China itself, right? Whether it's renewable energy, alternate fuel, and so forth, right? Just to give some facts, right? Despite the fact that the growth of the GP in China has been slowing down, right? EV cars last year has grown by more than about 150% on a year-on-year basis, right? I think the EV car market in China is probably going to be the largest one in the world. Tesla itself, as you know, has already set up a plant in China, or more than one plant in China, and I think they probably know that the demand for EV cars are going to be huge. And as you grow in terms of EV and as you grow in terms of the battery reliability and so forth, you need to build infrastructure, right? So I think the net infrastructure spend, from what I understand from the Chinese government, is to think about more of the right-hand side down here, which is in energy infrastructure and the efficiency of the technology, right? And so I think this is something that we're particularly very, very excited about, particularly in our Asian portfolios as well, where, as you know, we launched an Asian Renewable Fund a couple of months ago. So with that note, I think we're almost top of the hour in terms of 35 minutes. So I've been compliant, and so I should get some brownie points from this. But in conclusion itself, I just want to highlight 3 major key points here. Number 1, China is cheap. Relative to all the global markets I look at, the risk reward is really stacking up and very, very compelling. Number 2, I think if you think about policy flexibility compared to other central banks in the world, I think China has the breathing room to both do monetary and fiscal policy, especially when you're in an environment where you don't really have an inflation problem. Number 3, I do think that there are a lot of long-term opportunities in the renewable space, as you have alluded early on, whether it's going to be EV, battery supply, solar, alternate fuels, smart infrastructure. I do believe that China is ripe for what we call the next decade of long-term investments in renewables. On that note, thank you very much. I'm happy to take any questions.
Thank you, Patrick, for your valuable insights. Before we move to the Q&A session, do you have any last word for our audience?
Yeah, I think, there is a lot of noise about the property sector. There's a lot of noise about trade issues with US. I think you need to start thinking about this from a long-term perspective. And time in the market is more essential today than ever before than timing the market in China. Having said that, I think the Chinese equity market itself is not for everyone. Let's be clear about that. It is high risk with high returns. But having said that, for those people who have been following me for many, many years and looking at China, investing in China, you will know that when you basically have been invested in China and you know your risk, you will know the rewards from investing in China. So think about that from your portfolio perspective and navigate it accordingly.
Great. Thank you, Patrick. Ladies and gentlemen, thank you for staying with us. Please continue to submit your questions and like those of interest to you. While we're waiting for more questions to come through, I would like to share with you that if you invest into China with your EPF savings or cash via our online platform from today till 8 September, you will earn rewards up to 0.88% of your total net investment amount. On top of this, when you refer your family and friends to us, and for every successful referral, you and your referee will get to earn up to 100 ringgit rewards. Right, so let's move on to our Q&A session. So our first question is, are you ready, Patrick? Okay,
yes.
So do we still hold Alibaba in any of our China funds? Alibaba has been very volatile. What is the view of our fund managers about this stock?
Unfortunately, I cannot comment on stock-specific issues because for compliance purposes, right? Because when we cannot be seen to be biased against stocks. What I can say is that we do hold of these companies, but we are underweighted against the benchmark. What that really means is that we actually own less than what we should own from a benchmark perspective. So I think we are a little bit more cautious about this sector itself because the ongoing regulatory issues are ongoing, and we will just have to wait. We probably have to wait through all the regulatory risks before we start to get excited about them.
Okay. So our next question is, if you were to rate the stance on China now, should we buy, hold, or sell?
Well, if you've been following me for the last 30 minutes, I basically said that it's time to buy, right? So I think, having jokes aside, there's really no better time to invest in China than now, I think, when the valuations are where it is today, right? Having said that, there still could be some volatility out there. But I do think that, at 8 times PE on the H share and 15 times PE on the A share market, with potential uplift in terms of fiscal and monetary policy, I do think that this is the right time for investors who have the right risk appetite, or rather who understand China to invest in this market today. Okay.
So our third question for today is, okay, some China shares are delisting from US stock market. What will be the impact of China stocks?
Well, it really means that a lot of these companies will have to list either in the Shanghai Stock Exchange, which is the A share market, or the H share market, which is Hong Kong. I think early indications is that some of these companies will be listed on both Shanghai as well as the Hong Kong Stock Exchange, right? So I think you will have potentially extra liquidity going to these markets, and hence usually when the liquidity shifts, then obviously the market should be a little bit more supported on that front.
Great. We still have more questions. So the next question is, China recently turned back towards coal due to power shortages, and more recently due to hot summer heat wave. Does this still jive with their decarbonization direction?
Yeah, that's a very good question, right? I was just reading on Bloomberg just now as well. To be honest, I've yet to digest the information about this, but off my head, I think these are kind of phenomenons that's already ongoing also in Europe as well. So I think in the short term, maybe they may compromise on their so-called decarbonization matters. But even having said that, China being China, they're all able to navigate this a little bit better than developed markets simply because it's central economy, right? As you know, more often than not, in the winter months itself, right, China has a policy of not switching on its power plant. I remember going to Beijing many years ago in the month of October, November, right, prior to them prior to them actually switching off their power supplies at night, right? Basically you can't on any heater because it doesn't work. Electricity is going, but the gas is not going in. So they're able to control this. So China is very command economy, right? So if the carbon emissions get a bit too haywire, I suppose they will have means to control it. But then again, I think they're human beings, all right? They're not gonna kill. They're not gonna let everybody out there, go into a heat wave and have headaches, like.
Okay. Okay, so our next question is, which are the China funds available on this on our online platform?
Yeah, so for those who are not familiar with our platform itself, right? We have our flagship fund, which is the Greater China Fund. That's the largest fund, it's the #1 fund in the marketplace. And that gives you exposure to both the A and the H, as well as to a certain extent Taiwan. So hence the reason why it's called Greater China. If you want direct exposure to the A share market itself, we have a fund called the CDOF, China Direct Opportunity Fund. We launched that about close to, I believe, maybe 4 or 5 years ago. And that gives you a direct exposure to the CSI 500, which is basically the small cap index, right? That has generally done fairly well. I mean, despite the market volatility in China itself, I think it's only down by about 5% year to date, right? And that gives you exposure to all the kind of growth areas that we talked about early on, renewables, technology, and so forth, right? Then if you wanted a combination of both the A share and the H share market itself, we also have a Greater Bay Fund, which we launched about 2 or 3 years ago. That gives you exposure to technology companies in the Greater Bay Area. Greater Bay Area is basically outside of Hong Kong, Shenzhen, and in the Bay itself. That has basically been dedicated by the Chinese government to be the next big area for growth for China. Obviously, when you have a huge technology exposure down there, the fund itself is down by more than the other two indices that we talked about. But longer term itself, we are hopeful that things may start to improve, especially from a technology front, and things may start to improve. And of course, if you wanted a hybrid model, as I call it, and then you want a smaller position in China with other markets to invest in, we obviously have our flagship fund, which is basically Asia Pacific Dynamic Income Fund, which has close to about 40% of our exposure in China H share itself. So those are the funds that we have. And of course, we also have, for those who are Islamic investors itself, we also have our flagship Islamic Asia Pac Fund, which is about close to about 2 billion ringgit itself. So these funds are fairly big, very liquid, and doing fairly well despite the volatility in the marketplace.
Okay. The next question is, China helping and leading money for One Belt, One Road country to build their infrastructure. If coming financial crisis and make this country bankrupt, how it will affect China and the share market?
Sorry, the question is on the One Belt, One Road and how it impacts which countries?
China. China, okay, let me repeat that, yeah? China helping and leading money for One Belt and Road country to build their infrastructure. If coming financial crisis and make this country bankrupt, how it will affect China and the share market? Oh, it doesn't mention the country here.
Okay, so to put things in perspective, right? The OBO, as they call it, One Belt, One Road. Honestly speaking, it doesn't exist anymore these days. It's all talk now, right? The Chinese government has been very quiet about this and all the projects. So I think they are prioritizing their domestic economy at the moment, given they have property issues, given they have a lot of issues, right? COVID and all that. So I think it's put on hold. I don't believe at the end of the day, OBO will lead to a lot of other countries which invest in, if they don't invest in, to go bankrupt. I don't think it's that simple, I think it actually is a two-way street where the Chinese government itself uses OBO to basically reach out to the rest of the other emerging countries across the world, particularly in that route itself, the Silk Road itself, right, to basically build more infrastructure, which leads to them being able to harness a lot more, for example, commodities from wherever they are, like Africa and so forth, right? So I think that's the initiative, but I think at the moment, my sense is that HOBO as a whole, and I don't really hear a lot about HOBO at the moment.
Okay. We have two more questions. So which of these markets provide better investment opportunities? A share, H share, or Greater China?
All of the above.
Okay.
Well, I mean, it all depends on your risk appetite, jokes aside, right? So,
Yeah.
If you wanted a more diversified portfolio, obviously you want a combination of both H and A, which is basically the Greater China Fund,
Okay.
right? And that's our largest fund out there in terms of direct exposure, right? It is an award-winning fund. It's about 2 billion ringgit, the largest China fund, I think, in Malaysia itself, right? If you look at all the Lipper ranking itself, is number one. Even I invest in it. I trust fund manager very, it's run by our partner Schroders, right? But if you wanted something which gives you high growth, high returns, obviously you want to invest in the A share market, which is the CSI 500 market that we talk about, the CIO, right? So it depends on your risk appetite. Some people out there may be a bit young, they want to take more adventure, they want to take more risk. It becomes risk return, but if I think from a longer term perspective, right, both asset classes both H and A are quite interesting, Obviously, the H share market, without confusing you guys, is really where a lot of foreign investors invest in, the Guailos, right? The problem with that is that the Guailos have a different way of thinking about the Chinese market. They're all bearish, right? Only a very, very few of them are bullish, right? But the onshore guys, like I talk about, basically the A-share guys, understand the economy better. They know what the structure of the economy is better. So it depends on how you look at it, But my personal view is that if you buy in the H-share market today, your risk reward is really, really good. You're talking about 8 times PE, Whenever you're going to get 8 times PE, if 5 years down the road, think about it this way, right? Tell yourself in 3 or 5 years down the road, if you invest today, where do you think China will be? Is it going to continue to be slowing down, or is it going to grow? Then when you think along those lines, you know how to invest.
Okay. So our last question for tonight would be, how do you see the growing unemployment rate amongst new graduates will impact consumption going forward?
Very good question. So unemployment in the graduate is about 19% today, right? It is an issue. I think the government will start to issue more initiatives to make sure that the guys out there get employed. But the key of the matter is, right, that number itself at a 19%, right, exaggerates the total employment number that we have today. Excuse me. Why? Because the unemployment number is a function of two things, It's a function of the lockdown. It's also a function of the fact that we are also in the summer months when people don't hire that much, right? So it's school holidays, it's summer holidays and so forth, right? So I think the real number that we need to start thinking about maybe will be September or October later on. My sense is that I think that number could go down, but obviously the government is definitely looking into it, because ultimately at the end of the day, right, when you are focused on stability, right, unemployment numbers in China are very sensitive to the government, more so than growth these days. So if you want to be kind of re-elected in the next party election by October or November, obviously Xi Jinping and a bunch of the Politburo guys out there will have to do something about it. Hence the reason why, like I said, they will have to go out there, spend some money in fiscal, and make sure there are more jobs out there. Because if not, the unemployment number is going to go higher, right? Which is why I said, right, you just have to think about it this way, right? In the next 2 to 3 months, right, I think the government, after they had a 2-week holiday in don't know where they were the other day, right, they have to do something. So that's why this is a very, very good time to invest. Because once they roll out all of these contracts or fiscal policies or what have you, right, market will start to price this in already, and it will start to re-rate.
Okay. Thank you once again, Patrick, for the valuable insights and perspectives. I'm sure our audience today find the insights and tips utterly useful to help them navigate in this current market condition. So on that note, we would like to thank everyone for your participation today and your trust in Principal. We look forward to having you again in our future webinars. Stay safe and be well. Thank you and good night.
Good night, everyone. Stay safe and don't forget to invest. Thank you. Bye.
Thank you.